Hello everybody, thank you for joining us. What we'd like to do in the next 30 minutes or so is take you through three sections in this slide deck. First of all, an introduction to Impax for those of you that don't know us. Secondly, a business update, and thirdly, a financial update. So, an introduction to Impax really starts on this slide. Today we are one of the world's leading investment managers specialising in areas of the economy that are linked to resource efficiency and solving environmental problems. That means we're investing in some very rapidly growing markets around the world, large and expanding at a rapid click. And within those markets there's many hundreds, if not thousands, of companies that are of great interest using technology to solve these issues, improve resource efficiency and generally improve industrial activity and the provision of food and agriculture, water and other environmental goods and services. So those sorts of industries are very attractive to mainstream investors who are really worried about where economic growth is heading and are looking for pockets of outperformance, if you like. They also tend to be markets that are of great interest to those investors who are looking for something beyond financial returns. Some of those are ethical investors, others are just concerned about where the planet is heading. So although we don't set out our stall as ethical investment managers per se, we do attract those clients that are interested in that space. So the business today, which I started in 1998, has grown to, at the end of March, £5.7 billion under management. At the end of April was £6 billion, as we'll explain in a bit more detail. We do have a very well diversified international client base, predominantly institutional investors, pension funds and insurance companies, as well as private banks. And we're offering services in three areas: listed equities, infrastructure and property. We have a team of just over 70 people based in London, the United States and Hong Kong. And of those 70 people, 30 are investment managers. At the moment, of course, investment management as a sector is facing some interesting pressures. There's obviously more opportunity to manage money as wealth around the world expands, but at the same time there is a move in some quarters to passive investing, while at the same time there are many asset owners who are looking to active management to beat the market, to do something over and beyond the passive funds that they may own elsewhere in their portfolios. And so in that split world, then there's a lot of opportunity for Impax as offering a differentiated active management product. And given that we've got a very attractively positioned niche and a well-established track record and team, then we do find ourselves in facing a very attractive growth opportunity. We are reaching our clients through a well-diversified business model and distribution structure, which we've put together over more than 15 years. We do direct sales in the US and the UK and Ireland, and then we use third parties by and large in other parts of the world, particularly continental Europe, Asia, Australia and Canada. We're also well known for the work we've been doing to help define the opportunity set in, say, renewable energy, water treatment, or food and agriculture. We produce white papers which are on our website if you're interested, looking at climate change risk, energy efficiency markets, food markets, etc. And we are producing impact data around the non-financial outcomes of the portfolios we're running. These are elements of our service offering that institutional investors in particular are welcoming in many quarters. So environmental markets, as I mentioned earlier, are expanding rapidly. The world population is growing, more and more people moving into cities, more and more pressure on air quality, water quality, availability of clean soil. There's an infrastructure deficit, both repair of infrastructure in existing markets and new infrastructure, and there's plenty of demand for more and higher quality food. So these drivers are underpinning some growth, which is really leading to great business opportunities. Plenty of catalysts for investment, some linked to climate change policy around the world, which the Europeans and the Chinese are leading on at the moment. Of course, in China and London, other cities in the UK and many other parts of the world, air quality is a problem. So there are many businesses that are making great financial returns solving those issues. And the food sector is replete not just with growth opportunities around providing more protein, but also the consequences of food scandals and regulations that are limiting certain types of foodstuff, reduction of sugar, for example, and potentially down the road restrictions on the use of inorganic fertilizers. So moving on to the second section of the webinar, then the business highlights for what is the first 6 months of Impax's current financial year. So our financial year ends in September, and so we're reporting today on our first half results. So as shown on this slide and as reported at the introduction, we've had a very strong period. We've had 27% increase over 6 months in assets under management, and £870 million of that increase came from inflows. So those inflows are actually at a record level and have continued post the end of the period into April. Within that, we've been pleased to report that our North American assets under management as a subset of our total has exceeded $1 billion for the first time, which we've been working on for nearly a decade. Investment performance has been strong, and we've also had good progress in raising money for our current renewable energy infrastructure private equity fund. What that means in numbers is shown on this slide. So there's the £5.7 billion compared to data from previous periods. Revenue this period is 13.9 million, which is a substantial increase on 12 months ago. Operating earnings also nicely up, so double of what they were in H1 2016. Operating earnings and profit before tax have been impacted by an accounting issue, which is just a question of accounting policy that Charlie will talk you through, but those have been depressed below what they would have been, and that depression is actually reversed out in the EPS line. So EPS is up very nicely as well, and we're also pleased to report a 40% increase in the interim dividend to 0.7 pence per share. This chart here just shows the assets under management growth compared to our history. So this has shown nearly 20 years of solid effort to build the company, and you can see that we've been scaling the business very rapidly in the last 3 or 4 years. So environmental markets and resource efficiency are set for really very exciting growth in the future. Some people are concerned about what President Trump is talking about in this area. Of course, he's not supportive of climate change policy. Having said that, his plans to provide more industrial-oriented domestic growth are very good for many of the companies in our space. Our companies, generally speaking, are helping industrial businesses and other commercial businesses improve efficiency, so more industrial and commercial activity means more demand for goods and services of companies we're investing in. More shale and oil gas exploration means more need for higher requirement for clean water and for recycling and waste management, so that's good for many stocks. And even renewable energy is an area which is supported by more than half the states. It creates local, regional jobs and economic activity, and is a great component of energy security. So we expect renewable energy to do well under a current Trump economic plan. So all in all, the US remains a very strong destination for the funds that we're managing, and we are continuing to sharpen our pencils in working out where there are pockets of deep value, and making sure that anything which is risky is pruned or exited from the portfolios. Investment performance has remained very good. These are our numbers on the left and the middle of the page compared to the All Country World Index, for which most investors have a sort of opportunity cost type comparison. The only thing to be pointing out in addition to that long-term very good performance is that in Q4 calendar 2016, the strong reversion, positive bounce back of energy and financial stocks in the world index, sectors we don't have exposure to, meant that we were somewhat behind the world index in that particular quarter. That negative effect has been significantly reversed in the first 4 months of 2017, so it is seemingly just a very short-term effect. In the real asset space, we've made further progress in exiting the second of our renewable energy infrastructure funds, and our third fund is moving nicely in gathering new assets. We're at €185 million in that third fund, with an additional €31 million pledged by the European Investment Bank. So we are marketing that fund for another 9 months or so. And in sustainable property, a business that we brought on board in 2014 at quite a small scale, we are exiting, or still in the process of exiting, the final asset of the first fund and talking to investors about second fund. The AUM growth by region. This is where our clients are based. Very strong increase in continental Europe, led by BNP Paribas, who market for us around continental Europe. ASN Bank in the Netherlands and Absalon Capital in Denmark have also contributed quite significantly in this increase. And the other strong area for growth has been North America, where our US business in particular has grown nicely. And in the context of the listed equity strategies, then there's been good increase in the 4 major strategies where we've already got critical mass, as shown on this slide. The water and the food and agriculture strategy are being significantly marketed by BNP Paribas, but specialists and leaders are much more diversified around the world, lots of different routes to market. And then this particular slide shows how the AUM increase on the left has broken down between inflows, outflows and market movement over the successive 2 6-month periods to the end of March. So H1 2017 compared to H2 2016. So you can see a very nice ratio of inflows compared to outflows at a time when the markets have been growing as well. The weighted average revenue margin has dropped slightly. That really reflects the fact that a good proportion of the new monies coming in have been in the third-party funds and accounts, where we typically have slightly lower revenue margins compared to the segregated accounts or Impax label funds, where we tend to have slightly higher margins.
Great. Well, I'll now take you through the financial highlights, and what's great to see is that the very good business performance that Ian's just described is feeding strongly through now to the financial results, best illustrated on this first slide, which is the operating result. So firstly, revenues are strongly up compared to the previous year. This is driven mainly by the listed equity business, where 2 million of additional revenues have been booked in respect of the growth in assets under management. The private equity fund, the third fund, is also contributing new revenues, largely replacing revenues from the first 2 funds that are now reaching the end of their natural lives. Importantly, the revenue booked to date is of course backward looking, so nearly 14 million for the first half. On a run rate basis looking forwards, this is 30.6 million per annum as of the end of March, and the growth to 6 billion by April takes that up to 31.8 million of revenues. So really encouraging growth in revenues coming through now. Operating costs, 2 things to point out. Firstly, staff are our major cost, and that's the increase in staff costs you can see here is primarily due to profit-related remuneration, which rises in line with operating earnings, so is clearly variable. The other thing is the point that Ian referred to up front, relating to an accounting quirk relating to national insurance. What's happening here is that we've seen a very strong rise in the share price of 60% over the 6-month period. This requires us to take a provision for national insurance relating to staff share schemes that are based on Impax share price. However, this is actually overall good news for Impax, because we will also get a tax credit that is bigger than that national insurance charge. So it's really quite spurious to regard the 0.4 million of charge that I'm highlighting in the light green on this slide as an operating cost. It's really quite different to that. If you then look on the right, you see the proof of the pudding in terms of operational gearing coming through now, and you can see the increase in operating earnings over the 3 periods. The 3.2 number that we're announcing today would have been 3.6 had it not been for this national insurance adjustment that I've just referred to. The operating margin of 22.8%, again if we look forward now on a run rate basis, ignoring this national insurance charge, is 27%, so significantly up on the prior periods. In terms of what this means for the overall earnings for Impax, firstly, diluted earnings per share, we can see the strong contribution coming through from the operating earnings that we just talked about. And at this level, because of the tax credit, the national insurance issue is not relevant. We do, however, see a negative effect due to seed investments. These are investments in our own funds that we hold to create new capabilities. We suffer market performance on those as any other investor would do. So in the last half of 2016, we recorded a gain of 0.9 million. And in the first half of this year, we've recorded a loss of 0.5 million. This is clearly variable, and sometimes you win, sometimes you lose on this item. And in this context, we've got a negative effect relating to that. However, the underlying operating result, I stress, is very, very strong, and on the back of that, the board has approved an increase in interim dividends to 0.7 pence, which is a 40% increase on the prior year, and at that level is 3 times covered and positions us very well for potentially an increase at the year end in the final dividend as well. Moving on to the balance sheet. The Impax balance sheet is very strong. We have no debt, we have investments, as I've just touched upon, and cash reserves. The investments, not so much has happened in this 6-month period, but I would note that one of the investments in our food and agriculture fund, we've now deemed to have been a success in that the fund is now at critical mass, the strategy is now at critical mass, and as a result of that have decided to close that fund and withdraw the capital. So the strategy is alive and healthy, but we can now withdraw the cash, and we will see that coming back into the balance sheet as cash in May. The cash reserves themselves have reduced since September of last year. This is standard seasonality for Impax. A lot of payments are made in the first half of the year. The main thing that's happened is operating cash flow again coming through strongly to boost our cash reserves, and various standard payments paid away, for example the final dividend in the first half of the year, and at the top of this diagram you can see 1.8 million on the dividend and net share buybacks. We've bought back 1.5 million shares from the market at an average price of 62p. Finally, on the right, in terms of characterising the 13 million of cash we hold, the way we look at that is to say that we need something like 6 million as a risk buffer, being a regulated business, the form that we are. So 7 million is available, classified as available cash in our terminology. Moving on, the balance sheet can be summarised as this cash and available cash and investments. So this slide shows there's something like 18 million of value sitting on the balance sheet in these two forms, which represents something like 17 pence per share. The final point I'll make is again emphasising the operational gearing that's inherent in this business model. If we look back on a slightly longer time horizon to 2011, we can see the development of assets under management, a tripling of business over that timescale. However, the number of employees has increased by a much lower proportion, from 48 to 71 as at present. And if we look on the bottom left and look at the total operating costs per employee, if we double the 143 number, that's 286, and we can see that that's actually lower on an average basis than it was in 2011, demonstrating that we're able to grow the business without in a very efficient manner. To the extent that we have brought on headcount, they've typically been at the middle and junior levels over that timescale. Finally, on the right, the non-staff costs are pretty stable. If you double the 2.5 to 5 million, it's broadly stable over this timescale.
So just moving to a conclusion, and this is our final slide. I think at a time when asset owners around the world are worried about where economic growth is heading and are particularly interested in opportunities to deploy capital in areas of the economy that are growing rapidly, then resource efficiency in environmental markets does stand out as being particularly attractive. The fact that Impax has had nearly 20 years of experience with pretty much the same team of investing in this area stands out and makes us a global brand leader amongst a very small peer group. And so for large pension funds, insurance companies and private banks around the world that are wanting to allocate to these areas of the economy, Impax is usually on the shortlist. That's really translated to a very well-diversified global client base, and we have very limited exposure to, if you like, UK private wealth, private banking, and therefore quite a resilient source of revenue spread across a significant number of products. We do think there's plenty of capacity left in the strategies that we run, so we can go from 6 billion to probably 10 billion pounds in the existing product range without the need for new products. And as we've been demonstrating over the last few years, it is possible to rapidly grow the top line while keeping costs under control through limited headcount increases. So that should translate to further scaling of the business, and we see ourselves as only partway through the long-term scaling plan for this opportunity. So the final point I'd make is that we do not have a star manager culture at Impax. We have co-managers on all of our strategies. We position ourselves for institutional clients in a way that demonstrates a collegial approach to investment management. And that, coupled with the fact that we do see that the secular trend for allocation to the space is growing rapidly, and the alignment that we have between shareholders, staff and clients through a very significant management ownership stake in the business means that we do think that we've got a very robust model to deliver that scaling over the next few years. So we'd like to stop there. Very happy to now move to the Q&A session.
Great, thank you very much, gentlemen. Quite a few questions. Let's kick off on the dividend. Is there any formula underlying your progressive dividend policy? And if so, might that formula be changing quite soon given the strong profit growth and encouraging outlook?
Thank you. Yes, the policy we've traditionally stated for our dividend is for a progressive policy, and you can see on the slide that we covered earlier on the growth that we've managed to achieve over the years. The situation we're now in today is that we've got a very healthy balance sheet and growing business, and definitely feel that the dividend is at the prudent end of the potential range. Last year's dividend was 2 times covered, and we see no reason to move away from at least that level of payout, and I think there's scope for further increase. What we are doing is considering whether we wish to actually state a formal policy, and we'll probably be making a statement over the next 6 to 12 months in respect of any potential further clarification of that.
Okay, thank you, Charlie. And one for you. Could you just clarify what the current cost-to-income ratio is for the group? And then I think Ian touched on this. You mentioned a figure of 10 billion sterling as being easily scalable. But would that be a point where either you'd be looking at taking on more expenditure via senior staff, or is it a case that you might be looking to add on new strategies? Lots of questions here. And then the last one, in terms of gestating, seeding and developing a strategy, how long might it typically take to contribute to the bottom line?
Sure. So I'll take the first point, which is the cost to income question. So the way we state that is our operating margin, which I touched upon on the slide that is showing now. The current run rate for the operating margin is 27%. So that is the 27% is the profit as a percentage of revenue. The flip side to that is 100% minus 27%, so what's that, 73%, 72% would be the cost base at this stage. And as we can see over the time series that we've got here, we are growing that margin, so we would expect that as revenues and the business grows, then the margin will increase and the cost to income ratio would reduce.
So maybe just picking up on the other elements there, the core plan is to scale up existing products, and essentially we feel we're pretty well staffed or populated at the moment with products that clients are interested in buying. The scaling of all 4 of the large strategies has been encouraging, particularly food and agriculture in the last couple of years. Asia, we still need to do some work to get that marketed, but now that Asian equities is back in favour, then we're reasonably confident of getting more clients in there. So the organic growth plan is very much the core of what we're intending to deliver over the next few years. We haven't ruled out making acquisitions if there are really attractive ones that would fit our core business, but it's not sort of a central engine of our growth plan. With regard to incubating new strategies and how long it takes to get those successfully founded, if you like, we are at the moment in the middle stages of doing just that with our so-called global equity strategy, Impax Global Opportunities, which is a more diversified exposure to themes linked to sustainable development. We've put in seed capital in 2015 into that, so we are cautiously building a track record, and when we get to the 3-year track record point, which will be sometime in 2018, then we would be hopeful of being able to gather some new flows for that strategy. So 3 years is really the proving time.
Okay, and just leading on to that, you mentioned global equities. We do have a question if it sounds it may be too early to comment about the seed investments that have been made so far in case of waiting another year, 18 months. Is that correct?
Yes, it is too early. We certainly are committed to leaving the seed capital in there. The process is being fine-tuned. It's working very well. The team's fully staffed. Performance has been okay. And we are reaching out to clients, consultants, just to get them interested in the strategy. I have to say that there's a lot of interest in global equity products with a sustainable development or a socially responsible theme, and we're seeing a lot of people both responding positively to our outreach and also in some cases knocking on our door.
Yeah, we've got a question on distribution specifically in Europe, which is, does the sheer scale of BNP's reach and the very strong relationship with you actually deter other distributors from partnering with you, or is it a case that you can find regional niches like Holland, Scandinavia, where you can add on specific interest?
Yeah, I think there's a couple of elements there. One is it's definitely in our interest to have a small number of focused and motivated distributors and concentrate our client service, if you like, on them. So we're not really looking to be adding a lot of distributors. Secondly, BNP Paribas is a very strong brand in many countries, particularly France, Italy, the Benelux region, and in those areas it would be unwise for us to be looking at anything else, to be honest. Having said that, we do have a very strong relationship with ASN Bank in the Netherlands, which predates the BNP tie-up, which started in 2006. Denmark, I think, is a market that's worth just highlighting. It's a very sophisticated institutional market with a large number of well-run and innovative pension funds in particular. And Absalon Capital, who we brought on board last year as a distributor, has got one of the best institutional client service and sales teams in Denmark. And we've already seen strong flows from that country, and we see a lot more potential from Denmark.
Thank you. Moving on to the onto NEF3, the infrastructure fund. Could you just share any changes that you might have seen in the last year or so of marketing in terms of appetite or questions and interest that prospective investors might have?
So I think there is globally a secular expansion of interest in getting exposure to the infrastructure space. So a lot of mandates, a lot of new inquiries for the asset class. I think renewable energy does stand out as a highly attractive infrastructure area because it offers very nice free cash flow generation potential and stability of cash flow over a couple of decades. There is a much more demand for what you might call brownfield infrastructure in that space than there is greenfield, which is a sort of double-edged sword for us. One, it means that we have to try a little bit harder to find clients in the first place because we're offering the greenfield or constructionally oriented solution. But secondly, once we've built the assets through our funds and are looking to exit them by selling them to brownfield-oriented investors, then there is a unprecedented level of demand for the assets, competing with traditional utilities. So this is very good environment to be selling the assets for NEF2, and actually for those investors that have got the flexibility to come into a construction-oriented fund, the potential for making very nice returns is proving to be quite compelling for them, which is why we've been able to get this fund off the ground and see further growth.
Okay, thank you. In terms of looking forward, do you have soft or hard targets on how you would like to see assets under management and revenues grow on a 3 to 5 year view? And if you do have, would you like to share them? We'll perhaps take that question first.
Yes, we've never really pointed to a business plan target on a firm date because we found over many years that the investment management industry is somewhat unpredictable in market levels and equity market sentiment. So what I think we can say is that having reached £6 billion just 4 months, £6 billion under management just 4 months after hitting £5 billion, there is very strong momentum in this business. We do have the ability to manage around £10 billion, and so there's no reason why we can't continue to build our client base in that direction. We don't really want to be guiding as to when we're going to hit that level because it does depend on successful ongoing investment performance and on market sentiment. So I think it's fair to say that this business ought to be growing towards £10 billion under management, but whether it's 3 years, 5 years or some other time period from now, I can't really forecast.
And perhaps a related part to that, having hit the billion in America, which is clearly a significant mark, would you now expect, because of the scale of that position, that the growth rate will slow down significantly, or is it a case that the market there is so large that you can continue making significant gains?
Well, I think it's undisputed the market is large enough for much more money to be managed by one manager. So tens of billions is certainly within our sights at some point in the future. In a way, hitting $1 billion makes it easier to market rather than the opposite, because it shows to prospective clients that we are successful with with their peers, if you like, and are almost by default committed to the US marketplace and are not, or much less seen as a European manager parachuting in on a sort of wishful thinking basis. We're now well established as a group that's been managing money in the US for nearly 10 years. And the $1 billion is a very positive milestone and should lead to further interest.
Okay, a couple of quick questions on personnel and the team. In the past, you've been able to add experts and external teams to open up and develop new strategies. Given how well the business is going, given how well the share price is going, is it now the case that you are being approached by top quality fund managers who would like to join the bandwagon?
Yes, I think the general point is absolutely correct, that as we've got higher profile and demonstrating an ability to attract capital, that we are of increasing interest to fund managers of many different shapes and sizes, shall we say. Having said that, there are really not that many vacancies because our current investment teams are by and large fully staffed, and we're not particularly on the lookout for new strategies at the moment, because we see that focusing on what we've got is the best way of building shareholder value, and we all feel there's quite a lot of diversification in the product range already. So we haven't closed the doors to new ideas. We do meet investment managers or small groups from time to time. It's not out of the question that we bring others on board, but it's certainly not a priority.
Okay, then perhaps the last question, again looking forward, how would you expect the growth of own label asset under management acquisition to compare with white label management of funds, and what are the margin implications for those diverse revenue sources?
Yeah, so I think because we're focused our direct marketing on the UK and the US, then the opportunity to get Impax label funds under management is principally limited to those two markets. In the US, there's obviously great potential there in general, but it's quite likely we'll be getting a lot of segregated account business. And we also have our white label arrangement with Pax World, where we're sub-advising a mutual fund for them, and that's growing very nicely. So I think the likelihood is, given the distribution of Impax's sales partnerships, that we'll continue to see more incremental growth in the third-party white label business, which is at a slightly lower fee margin, than we will in the segregated account or Impax label business. And so it's quite likely that the weighted average revenue margin in the listed equity business will stabilise or even go down slightly, depending on the products that are sold. So some of our white label products we get sort of 55 or so basis points, others are down at the 40 or 35 basis point level. Having said that, though, the absolute scale of this third-party distribution is quite phenomenal. So large volume at slightly lower cost is still an attractive outcome.